Good morning, traders. Welcome to the new week. Nearly through February already. It's been another speedy move through the months already. Morning, Stel. Morning, Kay.
Hello, morning.
Yeah, good weekend, all.
Yeah, very nice summery weather here, so it was nice.
Oh, summery weather already. Bloody hell, only February.
Yeah, it's been very throughout Europe. I mean, it's been very mild winter so far.
Yeah, no, it's quite warm here over the weekend. Surprisingly, very mild, which is nice.
Good.
All the flowers coming up.
Interestingly, the gas price here, for heating has not dropped much. I guess because we're still paying for gas bought, a year ago or whenever.
Yeah,
but
6 months.
Yeah, but now, I mean, natural gas has gone back down to pre-Ukraine levels, which is crazy, which is good.
Which is good, yeah. And if we finally see those prices ourselves, of course.
It's like the pumps, oil goes up, price goes up. Oil goes down, price stays the same.
Yeah, exactly. Bonkers. How's your weekend, Kay?
Yeah, all good, mate. Yeah, as you said already, weather pretty decent. So we went for a few walks along the coast and everything. Now, very good, man. Very good.
Lovely. Cool. Well, let's crack into this week. See what's going on. Let's start with what we've got coming up this week. As you can see, fair bit on the calendar. Flash PMI is kicking off this week from across everywhere, really. Those all come in starting tomorrow, where we get a batch of the European PMIs going through to the US later on. It's not too much busy in the rest of the week. We have some US GDP data coming up. I think that's the final numbers or close to the final numbers for the US there. So rear view mirror stuff. FOMC minutes, one of those things where they used to be something that was pretty strong and the market moved on. But because we hear from every Fed head 65 times since the last FOMC, if we don't know where they're leaning this by now, those minutes won't give us anything new. Looking over to Thursday and Thursday night, Japanese CPI potentially going to be another big number in terms of what happens with the Bank of Japan, the yen, and all that sort of stuff. On Friday, we have some more housing data, as well as the PCE numbers coming out, which obviously big for the Fed because that's their preferred method of inflation reading. However, we move enough on the CPI numbers, these PCE numbers, lightly just now, a bit like the PPI we saw last week, confirm or show us something different to what we've seen already from the CPI. Each time we get these inflationary numbers, the market has moved. So we should perhaps look for that to have similar effect, maybe not as big, if it confirms what we've already seen from the CPI and PPI since then. Final numbers from the Michigan survey coming in on Friday as well. So a few bits and pieces going on this week, but not hugely busy. Obviously today is a US bank holiday and it's a holiday in Canada as well. So those guys are all shut up shop for the day. So let's get stuck into some of the headlines from last week over the weekend. Reuters wrote a couple of pieces. The first one, China saying that mortgage rate cuts are spurring a prepayment rush and threaten bank earnings. Now, this is part of China's work to get the property market back on track. They were cutting mortgage rates, offering incentives for people to borrow. However, that's not worked out quite as they wanted. Instead of people taking up new mortgages and loans for new houses and stuff like that, they've been borrowing money to pay off mortgages at higher rates. So it's all a case of pretty much what's happening in Europe and with easy money and easy policy, people borrowing at lower rates and they're chipping off loans and borrowings at higher rates. So not quite going the way China wants. This leads into another story that Reuters dropped, saying that the PBOC has asked banks to slow down lending in February. Again, that might be one of the factors in that mortgage rate cuts, that people are borrowing for the wrong reasons in terms of what they want to do. So they've asked banks to slow down the pace of lending in February. Now, we did have a rate decision, or a rate outcome over the weekend. The LPR in China was all left unchanged, 1 year at 3.65%, the 5 year at 4.3%. This is another one of those intermediate lending rates that some in the market have been looking for the PBOC to ease, just to help things along. I am getting a feeling more and more that we may not get any easing from China. If the economy picks up a bit, they could be facing the same sort of inflationary pressures that the rest of the world might be facing. So at the moment, I'm leaning towards the fact we may not get some easing in China, but obviously, like everywhere else, it's going to be data dependent. What do you make of the China situation, guys? It seems all the talk is about easing, but is there a case to ease?
The thing is, we're expecting, or people were expecting this easing to come in Q2, and now, of course, when we are only halfway Q1, and people are already saying, well, they didn't move. Well, I mean, if you expect for Q2, why would you expect to move in Q1, right? So I think it's just going on its normal course. The only thing I see is that over the past weeks or months, PBOC hasn't injected any more funds than they have done in the past, than in those last 1 month and a half or 2 months. So I still think they are very much on the easing boat, and trying to underpin the economy wherever they can. And we will see Q2, what Q2 will bring, and also I think we have to look at the political situation as well. But if you take only the economic situation, if they are still building up their reopening, then perhaps in Q2 we will see these rate cuts, just to try and kickstart the whole thing again. But then of course the political situation will kick in on the side of it, between China, Russia, Europe, US, whatever.
Yeah. Yeah.
So I think it's probably a bit early to draw any conclusions from what's going on there.
Yeah. So data dependency will be evident there as well, to see how much of a fallout there has been from the prior COVID waves and lockdowns and stuff. And if we do see solid numbers coming into the next quarter, it will obviously ease thoughts about whether they need to ease themselves. But all stuff to be seen later on. Now, there were some waffly comments from a Bloomberg piece that the Bank of Japan may do something that will shock markets in Kuroda's last meeting, apparently to help Ueda on his way to ending up the ultra easy policy. Bit of a funny story, this one, saying that they may do something, either with YCC or anything at all, just to set Ueda on his path if he's going to be taking the bank out of the current situation. Large pinch of salt, large bags of salt, I think we take with this one, don't you think, Kay?
Yeah, although we did say last year even that Kuroda may do something to prepare the terrain for his successor. So I'm not saying they will. I rather think that Kuroda and his deputy Amamiya will let the heavy lifting do to the next team. But never say never. But it's just opinions, right? We don't really know what they are going to do. But as you were pointing out, to the Japanese CPI later this week, get a big one, and then the hearings which come up on Friday in Parliament. Ueda will be heard, his nominated deputies will be heard, and then I guess from there we will see probably speculation about what is to happen on the next Bank of Japan. So I think from Thursday going, the yen could go on the move again.
Yeah, definitely going to be a big event. I think if we finally hear from him, he's been shackled really on his comments. Was told by the bank not to issue any comments ahead of the hearings, so it could be a big event when we get all that stuff coming out for that parliamentary appearance. So that's going to be big for the yen later on. Speaking of Amamiya, he says there's still a lot of work to do before his term ends, but that the BOJ has the operational tools to achieve an exit from ultra loose monetary policy. So again, some might think from those comments that he was speaking in Parliament, that plays into the potential that some in the market are looking at for a shock to come from the next BOJ meeting. The RBNZ, their shadow board sees the OCR rising 50 pips in February. Just looking at the odds, they're pretty much kicking in an open door because a 50 pip hike is priced or probability at 94.3%, with 25 BPs the other side at 5.7%. So as I say, kicking in an open door on that one. Little fat boy, our mate Kim Jong-un in North Korea has been throwing his toys around again, launching missiles, and North Korea said the weapons used are tactical nuclear attack weapons. Even China was out overnight saying they are concerned about what's happening on the Korean peninsula there. Riksbank minutes of their last meeting were out, and it pretty much underscored the hawkish slant from their last meeting. CPI is too high and underlying inflation is still rising, and the weak krona is making it more difficult for the bank. So as I say, underscoring what they said at their last meeting. No real change or anything really of note there. Kay, did you see anything?
Sorry, I was just reading something. What on the what?
On the Riksbank minutes.
No. It's just confirming what they said before, right?
Yeah.
No, I'm not reading anything new in there. Let's put it that way.
Cool.
Only just note that the Riksbank took note of the weakest stocky, and the market also acknowledged it. So stocky has been on the mending side, let's put it that way. It's not yet completely strong, but we are back to different levels there as compared to a few weeks ago. Yeah,
definitely. Right, over to the ECB and rate pricing. And last week, traders fully priced in a 3.75% peak ECB rate for the first time. Current rate at the moment on the deposit rate is 2.5%, and with expectations for higher hikes or more hikes, that leaves them pricing in or needing to do another 1.25 BPs of hikes, or 125 BPs of hikes. The pricing remains strongly for a 50 pip hike there at 93.4%. And the other side, we're pricing a 75 at about 6.6%. Still, the market's finally getting around to picking numbers for the ECB. Are they going to stop at 3.75, or are they going to be forced to go higher?
That's a good question. I mean, the ECB is still one of the central banks which is still hawkish, and they're telling us, guiding for a couple of 50s and maybe more. And it's surprising because the ECB is not known to be hawkish. And but I think as the Fed is starting to slow down and come to a halt, the ECB will follow. Of course, they were behind the curve. It started later, so they're going to end later. But I think the market's now getting to a point where it's, where it's pricing a pretty fair top end of the rates. Same with the Fed. Remember, we've been talking about it for a long time. We've been saying that we think the market's pricing a little bit too little, and more importantly, it's pricing cuts way too quickly. I think the market slowly, although the cuts are still priced into the Fed, is slowly starting to acknowledge that the Fed's going to be higher for longer, and it's a similar story for the ECB. So I think that what the market's pricing now is probably fair. Is there a risk to the upside? Yes, I think the risk is definitely to the upside rather than to the downside. but I think we're getting to a point where we are relatively fairly priced for now.
Yeah, and we need to keep an eye on those inflation readings. Obviously, France and Spain
Yes.
surprising with upside moves in inflation. So it adds to the sticky nature over there.
Yeah.
Now, ECB's Bill Roy was out saying that government should cut aid as the energy costs ease. As Stel just mentioned, well, they haven't really eased yet. But it's funny because the ECB, one of their drums they like to bang is about governments doing more on the fiscal front. And now they've done something on the fiscal front. They want them to drag it back fairly quickly because they're worried about the inflationary pressures that will come from that. But it's a bit strange to have ECB bods talking against fiscal measures, even though they are emergency ones. He says that we have clearly passed the neutral rate and now in restrictive territory, and the FX has been more favourable since the summer. Is he talking about euro strength there? Because if you take it from the summer last year, we're not too far off where we were, but we had all that move all the way down in the euro, and now it's all back up again. And euro strength again is something that they're wary of at all times. He said that action after the March meeting will be less urgent, so maybe that's when he thinks he's going to start scaling down calls for hikes. And get this, the reason the yield curve is inverted is because of confidence in the central bank. I nearly fell off my chair laughing, reading that one.
What do they mean with that? What do they mean?
Exactly.
I honestly don't understand. Confidence that what?
I know.
Yeah.
I don't get it either. Firstly, well, the first thing is because of confidence in the central bank. No one's got confidence in the central bank. Never have done, never will do, because as we know, they get it wrong more often than not. And as for the yield curve is inverted because of confidence, what is he talking about purely from the rate aspect, do you think?
I don't know. Let's say there is confidence on central bank, that there's confidence there. Everything, credibility is intact. What does that mean though when it's inverted? Confidence that anyway, I don't get it. It's okay. It's okay. We don't have to understand everything they say.
Kay, what's your thoughts on that one?
Well, I thought the opposite is true. If you have an inverted yield curve, that means that usually the markets in the longer end are less confident than in the short term. So I don't know what I don't even know what he means, to be honest, and I didn't even see what it has to do with confidence in a central bank.
Yeah.
Okay.
Exactly.
I think we all agree then. Good. I'm not the only crazy person here.
Yeah, we all agree. We don't have a clue what they're talking about, and the likelihood is neither do they. Let's move on to someone who may not be as clueless, but we're not sure. Fed's Bowman says we need to continue with hikes until we see more progress. I set her up for this one. Came out and said, your guess is as good as mine as to what happens next in the economy. That comment on Friday got derided in a lot of circles. A central banker basically saying, haven't got a clue what's going on, and get to guessing. However, that she was a bit misconstrued on our headlines there. She was saying that we have forecasts and thinking what may happen, and we're ready to go both ways, but we're not sure which way things will go. She said we're not there yet on interest rates, and consumers are still spending at a high pace. Fed's barking out again. He was out a couple of times last week. Controlling inflation is going to require more hikes, but how many we will have to see. Supports the 25 pip rate path as offering flexibility to respond to data. Now, we've had some comments between the US and China. There were supposed to be meetings with Blinken before the balloons came over. That got knocked on the head. But Blinken did meet his Chinese counterparts at a shindig in Munich. And rather than any easing of tensions, it became a bit of a mudslinging match. The US accusing China of, the spy balloons and getting up to naughty tricks. And China threw it back at them, saying that the US was far from innocent in those sorts of things either. The White House said the Chinese balloon posed a very real and tangible threat to the US. So at the moment, no signs of any easing of tensions there. Potentially, I don't know. I'm half in the mind that maybe we start seeing things ramping up a bit. There have been stories that the US is threatening China not to send any arms to Russia. There was a story out saying that they may be looking to do that, and the US is telling them not to get involved, and China's retaliated, saying mind your own business. We have to remember that unfortunately this week marks the anniversary of the Ukraine war. That also, aside from the terrible things going on over there, in a market sense, it does create a bit of a risk possibility if Putin decides to step up something on the anniversary. So that's something that we never like trading misery and war and things like that, but it is part and parcel of markets. And so anything like that is going to be a potential mover for risk. So we need to bear that in mind. What do you guys make of this Chinese US stuff? It all seemed to be getting a bit better. They were going to meet. Blinken was going to go to China for a meeting, and then the balloon started coming over and it's all shot it down in flames. Do we need to be more worried about a growing situation here?
I am just slightly more on my toes, to be honest. I don't like the rhetoric, and of course there's a lot going on in the press. But then if you look at the US defense or secret services or whatever, they are seeing signs of a buildup again of Russian troops on the one hand, and then this Chinese stories is also not really great. And then what I also read, and I forgot where it is, if I saw this headline right, is that China, Russia, and South Africa are planning joint military drills.
Yeah.
I mean, that is not great either.
Joint what? Sorry, they're planning what?
Joint military drills.
Oh.
And if you start to include South Africa, for instance, I don't think it's a very great sign either. So I'm a little on my toes for what risk is concerned, but just geopolitically, things are not really going for the better. And I'm not saying they took a real turn for the worse over the weekend, but at least the news that we got wasn't great. Yeah, as Angela said, the BRICS. Yeah.
Yeah, I mean, this won't be the first time they've done drills, China and Russia, since this has all been going on. They did some last year, I think, with India that time. I can't remember, but yeah, there's sometimes when you watch headlines as long as we do, and you just start to see more of a certain subject popping up, even if the headlines aren't big. It's just, becomes a constant flow, a bit like the Brexit thing with this potential deal on the Northern Ireland Protocol. It's been droning on for weeks and weeks. Yeah, we're going to announce something. Now we're on pause. We're going to announce something. Oh, there's more to be done, and so on. There's times when you just see China, US tensions type headlines crossing the wires more and more. You think there's something brewing. I hope not, but as we say, it could be another factor that we have to play in markets in terms of risk and so on.
Ryan, personally, I'm finding myself getting more and more numb to these things. It's like exactly like you said with a Brexit, with a couple of years ago. Remember the US-China trade negotiations? After a point, it's like, you know what? This will either escalate to World War III or we don't care. So,
yeah, exactly.
I know it's a joke, obviously, what I'm saying, but you know what I mean. So for me, there's going to be headlines here and there, an escalation, de-escalation, blah, blah, blah. I don't see anything really moving markets considerably and for a prolonged period of time, on this front. Go on.
There's one thing that just adds to it, is that Biden is actually paying a surprise visit to Kiev.
To Kiev, yeah, now, yeah.
They're talking right now on the wires as well. about more arms, about more packages against Russia, new military aid, and things like that. So I don't know. I'm not saying we should be on high alert or anything may explode sooner or later, but I mean the signs are to me at least. I'm keeping a wary eye on those things.
Yeah, I guess it's more the fact that it's becoming a bigger proxy war, really. It's not just Ukraine against Russia; it's the West versus Russia, and China potentially stepping in on Russia's side makes it a whole big kettle of fish. So, in one aspect, it's almost like Cuba, isn't it? The US versus Russia over another bit of territory. It's I don't know. You can make some comparisons, maybe or maybe not. Anyway, let's get stuck into what's been going on in markets. Have a look at dollar yen because we did get quite a big move on Friday. Yields, obviously, one of the big drivers there. 10's rocketing up to 3.9%. Caused dollar yen to get up to that 135 handle. We got above this area, the top of this potential range that we've been looking at previously. I've had that shaded part, as you know, on my charts for quite a while. At the moment, it's looking like a bit of a fake out, a bit of just a short-term break above the level. It couldn't hold. It got back under pretty quickly, and then it's holding under again. So at the moment, the range is in play and holding. I'm not sure today is going to be any bellwether for what happens in markets, given that the US is shut. So maybe tomorrow we need a better look to see how the market wants to play it. But for the moment, we are back under level and all the hard work's got to be done again. And as you can see, the levels are holding as they were previously. Now, this doesn't mean we're going to get a move all the way back down to test the bottom of the range. But if we continue to see this holding here, then maybe if nothing gives again, we do see a steeper pullback, maybe down to 133.5, 133, somewhere like that. But for now, it's going to take a lot to actually break this short-term trend that we've seen at least since February, coming off the lows down in the 127s, 128s. And looking at those yields, the 10 years, as I say, nicked into 3.9%, but couldn't hold on to it. So dollar yen is pretty much doing the same thing as yields are doing, as they have been doing previously. So quite a decent level up here, 3.9%. We've had a couple of attempts to do it late last year, and we've had another crack, and it hasn't worked again. So is that the market telling us that it has fully priced in a potentially, well, the Fed going where they say they're going at the very least? I think there's certain elements that might say that has been the case. CPI reports are out, PPI has been out. As I mentioned, PCE this week, it needs to do a lot to add more to what we've already seen. So perhaps it's just a bit of a stall point until we get some other data that confirms the market turning a bit more hawkish on rates and stuff. What are you guys? I mean, you covered. You were here in the afternoon. I took the afternoon off on Friday. Are you surprised that we gave up the highs in dollar yen and in yields that easily?
Well, it's the same as we've been talking about for quite a few sessions. There's resilience by markets, and I mean equity markets. So they're getting sold in Asian and European times, and then they get bought back up in the US trading hours, and that comes with yields kind of dropping and dollar retreating as well. I am surprised by it. It's very resilient, and all I can guess is that the market's still kind of maybe caught one way and getting squeezed a little bit every day. I mean, I don't know. I am very surprised. I don't know if Kay has any ideas, but I am surprised with the resilience of the market. And that's one of the reasons why I'm very, very careful and not pulling the trigger or on anything at the moment because of the way it's trading. You know, I really want to get short equities, but not at these levels, and I'm scared. You know, if I was short equities and I saw this price action day in, day out, I'll be thinking to myself, yeah, I got to get out of this trade. So
yeah,
it's
and I think also some context is needed. You know, the market turning more hawkish over the Fed. You know, even if the Fed say we're going to raise rates to 6%, that's still only, you know, 0.5%, at most 0.75% over their current ceiling. And, you know, 50 pips, 75 pips isn't worth hundreds and hundreds of pips in markets. It's not the same as when the Fed went from, you know, 0 to 2% in the current rate scenario that we saw all last year. You know, you're not going to see this type of move in the dollar and this type of move in yields again, just on the Fed maybe lifting their ceiling a little bit and the market getting excited about it. So don't be thinking that a more hawkish market or a more hawkish Fed means we're going all the way back to up to the, you know, 140s up there, 150s, because there's just not enough mileage in that size of potential hikes to come. But it still means we get some strong moves in the mean. Kay, what do you make of it? Bit of profit taking maybe on Friday after the moves?
Yeah, I was actually the other side of the ball on Friday, because it was the first real session in the week where the dollar kept all of its gains in the European session, and I said, like, well, perhaps there's a last leg in the dollar before the week ends, and the market did the exact opposite, is to take profits, and the yields are cooling back off into the long weekend. Yeah, so I think that's what we are going to see going forward. As I've been saying many times, we're data dependent. In regards to the equities, I've been saying, and I've been saying here, I've been saying on F.A.C.E, I wouldn't be surprised if they hold up if we trade a soft landing or no landing. The money has to go somewhere. And I'm only half surprised about the equity markets, and that's why I'm saying I prefer to have dollars than long dollars than being short equities right now. But yeah, I mean, for what's going to happen on a day-to-day basis, that's data going to tell us. I mean, this week is a big week. Also, we do have a G20 at the end of the week. We do have a G7, I think, as well, somewhere from finance ministers. And with all the data coming up, it's going to be another week where stuff can really be on the move, and then we're going to have at the end of the week the hearings for Ueda and his friends, and you know, the markets have to take a breather, have to reassess what's going on, and sometimes it's just enough not to find enough sellers for something to correct itself, and that's probably going on in the yields and probably going on in equities.
Yeah. I know you've got to pop off for appointments. Do you want to have a quick look at a couple of key pairs?
Yeah, I can have a look. I just want to have a look at really, because everything is going to depend on them, is those yields, right?
Yeah.
And just some really simple stuff, and it is going to be very simple. Like, look at what's happening in the 2-year yield. We've corrected back towards those highs again. I've cut this week off because I think it was a fat finger in back in November. So we're back close to where we were. The 1 year is still above 10%, is still around and above 5%. I've seen some perhaps change, because we used to, in the good old days, as I'm getting old, I can say that now. In the good old days, we used to look at the 2-year yield to reflect the market expectations for Fed funds and stuff, and terminal rates and things. But now it seems that the market has really shortened it since the pandemic, really. We are in accelerated cycles still, and I reckon that's why the market is looking at the shorter end of the curve now to reflect really, because they expect something to change on the back of higher yields, on the back of perhaps risk, geopolitical risk and things. So It's actually the shorter end, even the shorter than the 2-year, that reflects the closest to the expected Fed funds rate. So those yields, yeah, we've had a look above this. This was the prior high. We had a look above, and then now we are back to where we were, and until the next round of data, we could hang around this 378, 382, 83, and this is really why dollar yen is back down. Again, I think we may start to see some speculation surrounding the next governor, those hearings on Friday. So I'm going to be on my toes with yen. I'm actually I've reduced further my euro yen, even if technically it's still holding. It's holding the levels. I will show that in a minute, but I've reduced it. This could be enough until Friday, unless we get belter numbers out of the US. I think this spike above 135 could be enough. I'll have a look at it later on this week on the longer term to see where we can go. But in the short term, keep an eye on 85, 133.85 figure, 133.60s. And then back around this 133, the cloud should still not be too far away from there. Let me have just a quick peek at where the cloud is today. It's actually dropped quite significantly. Yeah, I said it was going to go low, but it dropped quite significantly. So forget about the cloud right now. But it is getting closer, and that's what I said on the top side. It is getting closer to those moving averages as well. So on the top side, we may have to keep an eye on it for Thursday and Friday. But this one is dropping off. So the 133 lost a little bit of its significance. It's now rather around 132. But anyway, I'm going to be cautious about what's going on in yen, because we could see flows developing in yen where market trying to speculate on what's going to happen on Friday. Then it's going to be 2 weeks until the next Bank of Japan meeting. So the yen could be in a scenario where we are going to do a bit bigger yo-yos as well in yen pairs. Anyway, euro yen, I'm keeping a tiny bit just because of the level around here. If we start to get back below 142.75, I'll be gone. It's been an okay ride. Been trading it around a little bit. I thought we could have had a look at 144s, but it doesn't seem to be able to reach there for now. So I'm keeping things very, very tiny. On other stuff, euro kind of held. I was talking about this 106. Kind of held around this zone here. We had a look not too far from the 106, but it held before. I'm not seeing too much right now here for today, but we have numbers. We have PMIs out, CPIs out, so the euro could be on the move. Also have US data out, so I'm going to keep a very close eye on what's happening around 107.75, 108 the figure. That's going to be the level on the top side right now. And then the bottom end of this 106, really 106 figure 30. That's where we should either find support to continue the range, or if we break, then I think there may be a very fast move in it until mid 104s. That for the euro. For the rest, really, right? Yeah, Aussie and Kiwi, perhaps. The Aussie looked very fragile and looked as if we could make it below 68, but then US yields also reversed the whole thing, and we are back through this 68, 60-90 zone. I tried a little short around this area, but got stopped overnight. Still hanging around the same level. We have data out of Australia as well, and quite a few data. We do have the PMIs coming out, and then when is it? Tomorrow
Yeah,
night.
I got the RBA sorry, RBNZ tomorrow night.
No, the RBNZ. So that's not the RBA, but the RBNZ can even move the Aussie, as we know.
Yeah, well, Aussie wage price index.
So I'm going to keep an eye on this zone again. If it falters, I think then in that case there's a case really to make for it to move down to 67.5. But for the time being, pretty neutral. On the Kiwi, yeah, this 62 figure 30 zone, a little incursion below, but the 62 figure 30 is holding. To be honest, I have a feeling that RBNZ may disappoint this week, but let's see how that develops. For the time being, still respecting this. I'm tiny bit in, but I'm not long. I'm a tiny bit short against this one here. But I mean, it's really nothing to even talk about big risk. But
there is a bit of a. There has been a few
I think they may disappoint this week. Yeah, Ryan.
Well, I was going to say there's been a few people in the market thinking they may not go a 50 because of the storms and stuff that have happened over there.
Yeah,
they might take their foot off the gas just to see what the impact of that has been, because they've obviously suffered terribly with those over there as well.
And also, Ora was already less vocal about further hikes than other central bankers. If we recall, RBNZ and Bank of Canada were amongst the first ones in, let's say, the G11 sphere to hike and hike aggressively, and they seem to be the first ones willing to also take the foot off the gas. Okay, RBA as well, but it could be that OR is just erring on the dovish side come Wednesday. It's just something I have in mind. I may be completely wrong about it, but something I have in mind. And this week,
when they also didn't they also come out a while back and say they only saw 2 more hikes and they've hiked about 4 times since then?
No, I think he actually called for a pause at some stage, and then they hiked twice since that, or something. I mean, but yeah, you're right. Or was less hawkish than other counterparts in other central banks. All right. This one is going to be a mover this week. I think we are still respecting this rising wedge, but I think this one is going to break out this week. So we're going to have a close eye on this one, and I think perhaps already on the PMIs tonight, but then especially tomorrow night, Wednesday morning, this one should start to break out. Call it 111 on the top side and call it 109.75 on the downside. I reckon that by the end of the week, we are going to trade at a different level in this one. So I'm going to start to monitor this one quite closely, this Aussie Kiwi. And the rest, we've seen, and I want to keep an eye on what's happening in MEX, because of course we've broken through 1850. We've even broken through the low just before around here, which I was looking at as a bit of a confirmation level, low 1840s. We've gone below, and now we're trying to get back to it. So for the start of the week, keep an eye on what's going on around in those low 1850s on the dollar MEX, if we confirm the break or not lower. So that's going to be pretty decent level to monitor. If we really confirm the break, I think we are on our way to change big figure again and going into the 17s. Bit similar on the Euromex. We've broken through the prior low around 19.75 here. We went onto the next bit of support, 78.6, and we are bouncing this morning, same as in the Euromex. Yeah, keep an eye on this one for 2 reasons. For one, technically and carry trade is one thing, but if we're starting to see risk falter, if something goes on in geopolitics, be careful for emerging markets, because they can react pretty violently to geopolitical risks. Although I would still argue that MEX, being America's side, the far from my bed safe haven, could still continue to play here. So that is it for me. Dollar China, first little support here seems to kind of hold, but I would rather look at the 684 again, which we were monitoring before to see if it holds. And that's also probably due to those US yields. We stopped in this zone. I think 689, 693 quarters is where we have to watch for further developments. So we are in a range here. I think 684, 691, and that's the one that I'm going to monitor going forward. And with that, Ryan, because I have to step out, I give it back to you.
Yeah, thank you very much, mate.
Have a good day, everybody.
Sorry, mate.
I said, have a good day, everybody, and a perfect week.
Yeah, thanks, mate. See you tomorrow, or later in the room, perhaps.
Sorry, ask me what?
I was going to ask you about that dollar mex, because you were waiting for that break as well, weren't you?
Yeah. Yes.
It's looking quite significant.
Haven't done anything yet. I'm thinking really strongly thinking about it. I haven't done anything yet because the US holidays day. It's I'm not pulling the trigger yet. I don't know why.
I know that. I get that feeling. I had that feeling Aussie dollar last week. Knew it was coming down. I still managed to trade it the wrong way. There's just times when you get a move and you just timing or whatever, you're not at your desk and it doesn't happen. I think as Kay was saying, I think the thing with breaks is if you miss it, it doesn't mean you've missed it, because if you do get a test back up to this 1850 area, 1849, whatever, and it holds, that's when you can get into a trade.
Yes.
Because you know where your risk line is. Above sort of 1851, 52, maybe even 55 if you want to push the boat out a bit. If we hold those levels, then the chances are it's going to come back down again, and you might at least get a move back down to these lows, if not further. So as we're fond of saying, there's always more than one way to skin a cat in this game. So just because you miss a break doesn't mean you've missed the move at all.
Yeah, we did say on Friday that probably the ideal thing is for this to break lower and then come back up and retest, and then fail. So that would be. Yeah, maybe that's what I'm waiting for. I haven't decided yet.
Yeah.
Sorry. Sometimes, it's this gut feeling thing where sometimes I'm like, yes, I'm doing it right now, bang. And other times, it kind of starts playing out and I'm still a little bit hesitant. So I don't know what it is. Is it gut feeling? Is it experience that I've seen this before? I don't know, but sometimes it's instant and others it's not. Yeah. And this one is one of them when it's not. So
yeah, exactly. And Mark wants to have a quick look at silver, which again, interestingly, we were holding this 22 handle. It's now under, and now it's finding resistance into there. So again, if you were potentially looking for a break under 22 and missed it, well, maybe here's your opportunity, because we're not getting back above 22. So you've got a fairly low risk chance of shorting here. You don't need to have a $2 stop on it or anything like that. If we're back above 20 and holding, then you're wrong. But if you wanted to be looking at shorts, if we don't break this level, there's every chance we head back towards the lows again. Maybe we're getting a little bit of a short-term range developing. Maybe it breaks and heads on further down to the 20s. Who knows? But, you don't have to miss a trade on the first instance and miss it the second time. There's always ways to trade these sort of things. We've obviously spoken about this before. Still, it's not looking too hot for silver at the moment.
No.
What's your gut feel on this? A bit more downside to come before a bounce, or can we make it?
Most likely, I think yes. That's why I've only got the very, very small long at the moment. You know me, I like to accumulate slowly. Next level really is a 21-ish handle, nice round number. It's also 200 DMA. It's also a 50% fib. So a lot of confluence there, or actually 50% fib is just below 21, but it's going to be that level roughly. and then if that goes, we're looking at the high 18s. So and that's really where I'm going to start getting. I will probably get another quarter size in at 21 if we get down there, and then I'm going to leave the other half for the high 18s, 19 somewhere there. But to the upside, the level is very, very easy. There's one at 22, like you said, and really after that's 24.50. I mean, it's there's 22.50 as well, but the big one is 24.50. So for me and my time frames and my way of trading, that's the one. And but yeah, it will depend on the dollar, it will depend on the Fed, the yields and everything. And the knee-jerk reaction is always to sell the metals when yields are rising, when the dollar's rallying, even though it's a very perverse reaction, because we've said before, all this is happening because inflation is going higher. And it seems that inflation is carrying everything higher except silver, which is used everywhere. So, and there's a big deficit this year, and they're projected as well to persist going forward. So it's for me, it's a no-brainer on a macro level, but timing it and getting the leverage right is crucial. And I personally have no leverage on this. So, and I've talked about this before, but all these people who have been following us will know this. The last long I took in silver, the last big position long, actually, no, I had one which I closed, remember, in the high 23s. 24, that was a nice one, but the last major position I had was pre-COVID, unleveraged, was long around 15-ish. Had to ride it all the way down to 12 or 11.8, what was a low, because I had no leverage, and I was comfortable enough doing that, and then I got rid of it at 25. So
just play the ranges. That's all we do.
It's
right, couple of. Sorry,
go on. No, go on.
No, go on. You finish off.
No, I was just saying the way I trade. I don't recommend people do that. It's the way I trade, and it gives me a lot of leeway with my stops and with my the way I scale in and out. And my timeline is a lot longer than most people. But then again, my targets are a lot larger. So
yeah, exactly. Right, so DJ says some more BOJ intervention is not off the table. I'm not sure they're going to be intervening if we keep going further down, but intervention, as we know, with the BOJ is all about volatility, not about levels. So yeah, it's never off the table, but I don't think we're in any sort of intervention territory at the moment. Surab says, would you gents generally be less active today as US is closed? Yeah, definitely. But that doesn't mean there's not trading to be done. When you get quiet days like this, when the US is shut, the afternoons can be a bit quiet. So, if you're a scalper or a short-term trader, this is probably the perfect market for you. You can nick a few pips here and there. Conversely, look for anything outsized, any moves that are outsized, a bit of out of sync with the rest of it. For example, if we saw a big sell-off in the dollar, you've got to think that might be a bit out of kilter with what the market has been leaning recently, i.e. more hawkish to Fed and more of a dollar dip buyer. So if you see a big dollar sell-off that doesn't look not driven by a headline or anything massive, maybe around the fixes, the 4 o'clock London fix, maybe that's something, if it hits some levels, you look at and think, well, that might be a bit of a fade for when the Yanks come back in tomorrow. Ali, currently tell me situation next BOJ governor. Which governor is bearish? Well, we've been over we know who's coming in. It's Ueda, so it's not about who is going to be bearish or bullish. Amamiya is a deputy governor. So basically, the long and short, Kuroda, Amamiya, and some of the other colleagues are all leaving. They are obviously the big proponents of easy policy, hence why potentially Kishida, the PM, wants new people in who can take them out of that. There's no point in going like for like. As for overall hawkish, bearish, dovish, whatever, we won't know until we actually hear from, in the main, Ueda, to see where he's actually going to set his stall out. So that at the moment is an open book. it's an open risk, at least on Friday, when we get him appearing in Parliament and we know what he's going to say about things. And until then, we're all going to be confused, Ali. So it's a wait and see game. But we'll talk about that plenty, I no doubt, this week. So for this today, at least, thank you very much for coming to the Flow Show. Thanks, Dale. Thanks, Kay. I'll thank Kay later on.
Thank you, Ryan.
Do have a good week's trading, and we shall see you all bright and breezy tomorrow. Oh, is there F.A.C.E today still?
Yes, there's going to be one. Steve really wanted to do one, and unfortunately, he drags me into it. So yes, me and Steve are going to be doing F.A.C.E and then Morning Edge as normal. Yeah,
no, there's no interview today, so it's just
no
F.A.C.E. So we shall see you on F.A.C.E later on, if we can get a word in edgeways with Steve.
Thank you, Ryan.
Thank you very much, boys and girls. See you tomorrow.
Bye-bye.